Hello, everyone. This is TradingLink's weekly trading update session. This week marks the fourth week of October, with only one more week remaining in October. We are swiftly approaching the first week of November and the U.S. presidential election on November 5th. Ahead of this major political spectacle, the U.S. election game has brought about quite a peculiar shift in the market. Let's take a closer look. Starting from October 19th, gold has initiated another upward surge, moving from the 2,600 mark to reach to 760, representing approximately a 16-fold increase. In the past 2 weeks, we've maintained our long position, anticipating further upward momentum. As previously discussed, the recent dip and consolidation were merely a technical correction, a shakeout in form. During these few weeks, many long-position hedge funds exited their positions. Once positions adjusted, a rapid rally ensued. On Wednesday of this week, gold experienced a roughly $40 decline. Many traders began to short, thinking that the 2,750 level might be the year's peak. However, this market requires closer examination. Our advice, along with TradingLink's general trading strategy, is to continue holding a long position, though likely for a limited time. The reversal phase may not be far off. The unusual nature of this market stems from the prevalent focus on Trump trades. Speculation around Trump's re-election as U.S. president may drive the reasons behind this rally. For instance, since October 1st, the US dollar has shown steady upward momentum. Yet gold has also been rising, a rare phenomenon, defying typical historical trends. Generally, gold and the dollar exhibit a strong negative correlation, where gold usually drops during a dollar rebound. Despite recent declines, gold has rebounded sharply from its mid-Bollinger Band level on the daily chart. There's historical precedent for this pattern, and examining past daily K lines reveals market manipulation tactics. Take, for example, the K line in 2016. When Trump won the presidency, before Trump's election, the market anticipated that his victory might cause significant political and economic fluctuations in the U.S. As a result, gold, a safe haven asset, rallied quickly from $1,250 to $1,300, nearly a 15-fold increase. On election day, as each state win by Trump's Republicans became evident, gold surged from $1,270 to around $1,350 by the afternoon. Yet, once Trump's win was confirmed, prices reversed, plunging from $1,340 down to $1,120, a drop of over $200. A substantial decline that stretched from October 9th to December 22nd. This current market movement might repeat that history. In other words, based on our discussion, our conclusion is to avoid shorting gold for now, as there could still be around 2 weeks of a bullish trend if Trump wins next week. Wednesday's short sell activity was merely a technical pullback. Avoid falling into the trap of shorting at this level. Yesterday, we saw a typical bullish pattern, with Asian markets opening flat and surging before the U.S. market led to consolidation, only to recover. On the weekly chart, both the 5-week and 10-week moving averages show an upward trend, indicating continued bullishness over the next 2 weeks. From a yearly perspective, we are witnessing the final accelerated phase of a prolonged 2-year uptrend that began in October 2022 and accelerated in March 2024. His final acceleration phase is likely reaching its peak, and we anticipate a significant top around November 5th. Avoid establishing short positions against the trend until then. For those who haven't held any long positions this year, consider placing high-level short orders as a hedge, such as a $10,000 order with 0.5 lots, while simultaneously maintaining smaller long positions like 0.01 or 0.05 lots. This type of long position, with a high-level short order, serves as a hedging long position, also functioning as a protective short order. These are small orders taken in the trend's direction. Once positioned, you can hold onto the short order at the peak, potentially at the highest point on election day if Trump wins, and aim to capture a significant downward movement. This substantial drop might reach a monthly level below 2,600, likely delivering a 20-fold movement. Before the year ends, we believe this will be one of the best trading opportunities available. This is our overall trading strategy for gold. As for crude oil, this week saw unusual behavior, because last week, we mentioned that this specific K line showed a clear bearish suppression, preventing the bulls from rising. On Monday morning, the market opened lower and continued to drop, but as we all know, a crisis occurred on the peninsula over the weekend, Following last weekend's Middle East tensions and Israel's statements regarding possible retaliation against Iran, all prices opened lower on Monday and even hit a circuit breaker, a rare occurrence. The price quickly dropped from $74 to below $72, and there was a circuit breaker triggered at 3:45 and 4:45 during the halt. It's quite rare to see a circuit breaker during a trading halt in crude oil. We believe this move might be laying the groundwork for a future K-line. Therefore, at last Friday's close, we acted without hesitation. We decisively established a long position at the key level of 68. Fortunately, there hasn't been a pullback that hit our long position stop loss. However, the overall trend this week has not been very favorable, and everyone should be aware of this. The reason for gold's rise is due to geopolitical instability. However, the asset most closely linked to the Middle East and most affected by these factors is crude oil. So why hasn't crude oil risen? It's very likely setting the stage for upcoming K-lines. So continue holding long positions, including existing long positions. Even if you enter a long position at the current price, it's fine. Once the price surpasses $72.35, the 60-day moving average may initiate a significant upward move. The driving factor here could be Israel's retaliatory actions against Iran, which might commence before the election. Personally, I think it could be delayed by 2 weeks after the election, but there is still a high likelihood of a sharp rally and rapid price surge. As for how this crude oil trend might unfold, we can look at historical K-lines. 3 years ago, during the Russia-Ukraine conflict, a similar type of news emerged, leading to a lower opening and a weekly adjustment. On Thursday, there was also a false upward breakout. Looking back at historical K-lines from 90, I recall that day when the price rose from 90 to 100, only to close below the starting line at the end. On Friday, there was a small doji candle. However, starting on Monday, there was an immediate jump of $95. On Tuesday, there was also a record high single-day increase, rising $11 in one day. On Wednesday, the rally continued. On the daily chart, you can see that the price was forcibly pulled up along the 5-day moving average. On Thursday, there was a pullback, and by Friday, you could see the closing line starting from 1 a.m. forming a bullish candle with no upper shadow. All the short positions were deeply trapped at this level, around $20 underwater. As a result, Monday's opening saw a high gap, opening at $103 and then jumping to $130. I remember that the data at the time showed an immediate opening at $130. The displayed price was $121, but that wasn't accurate. The actual opening was at $130. So, in roughly 6 trading days, Friday, Monday, Tuesday, Wednesday, Thursday, Friday, and then Monday, there was a $40 increase in price. However, before the entire upward movement, this phase involved a very clear bearish suppression. Many in the market believed that this wave of military action had ended and established short positions as a result. After all, the $100 level was still quite rare and represented previous historical high. This entire wave, stemming from the Iran-Israel conflict, didn't create as intense a shock as expected. However, 2 weeks ago, we believed there was still a chance to break through this high point of $78.46. In the short term, crude oil remains bullish, especially in the coming 2 weeks, particularly if Trump wins the election. The probability of a bullish start in crude oil is much higher than that of a bearish one. Why? Because the Democratic Party has always opposed a steep rise in oil prices. This whole wave of Middle Eastern geopolitical tensions hasn't led to particularly high price movements or trends in crude oil, and there haven't been especially good trading opportunities. A few days ago, Iran launched 180 missiles, yet this only moved oil prices by $12. However, if Trump is elected, crude oil may enter a cyclical uptrend, potentially leading to a substantial increase. Therefore, existing long positions in crude oil around 68 and near the current 70 level can continue to be held. It's important for everyone to understand that the Democratic Party's political elites have their capital and funding structures primarily rooted in internet technology and Wall Street sectors, whereas the Republican Party mainly relies on oil magnates and arms dealers. Lastly, let's take a look at Bitcoin. As we previously mentioned, this entire wave in Bitcoin is still promising. Our forecast from a few days ago indicates that before Trump's election, there's definitely an opportunity for Bitcoin to break past its previous high. However, when breaking this high, we mentioned that if it breaks through particularly strongly, we could look back at the previous week's strategy. If the breakout is particularly sharp, we can consider closing positions at this high level. At the very least, set a stop loss at the 72,000 level as a cost basis. During the retracement, use this historical high as a support base. As the price continues upward, even if it breaks through the previous retracement line, we can still pursue additional long position. However, as we mentioned, once it breaks through 72,000, we must set a 72,000 level hedge stop loss. For example, you could use your futures contracts to hedge against spot market risks, because if it breaks the high before the election results are released, an unexpected election outcome in the market could lead to a downturn. If a downturn follows, Bitcoin could experience a significant decline, making it difficult to recover. If you're stuck at the previous 72,000 level, be prepared to exit the position if necessary. Lastly, let's discuss the US dollar. In the short term, the dollar is definitely exhibiting a bullish structure. Currently, the Federal Reserve's rate cuts have had a significant negative impact on the dollar. However, various data are supporting a strong bullish trend for the dollar, helping to prevent a capital outflow from the US overall. There are substantial trading opportunities in the next 2 weeks, but there are also considerable trading risks. Wishing everyone good returns in the next 2 weeks. That concludes our analysis for this week. Thank you all.